All right. Good afternoon, everyone. Thank you so much for joining us today. My name is Stephanie Creedon, and I'm the Events and Webinar Specialist here at Wolf & Company. I'll be your host for today's webinar on benchmarking employee benefits plans, keys to an optimal program. This is the first part of our three-part webinar series on fiduciary governance, obligations for credit unions. So before we get started, I'm going to go ahead and just release a poll while I go over the housekeeping items for today. And the first poll I'm going to launch is, are you familiar with Zoom's interactive Q&A and polling features? So Jeff, if you just want to go ahead to the next slide. Perfect. Today's presentation will last about 1 hour. This is inclusive of any time for questions that we'll have at the end of the presentation. Today, our audience will be muted during the session. So if you do have any questions at any point throughout the presentation, please send them in to me by using the Q&A box featured at the bottom of webinars of the Zoom webinar control panel. We will be taking all questions at the end of the webinar. A copy of today's presentation and recording will be sent out 24 hours after the webinar concludes. So please feel free to pass along to colleagues who may have not been able to join us for the live broadcast today. So I'm going to go ahead and end that polling. It looks like we do have some people attending that are up to date with Zoom's polling features. Perfect. Great. The next slide, I'm going to introduce today's presenters, Derek Graves, who is an audit principal at Wolf & Company, and Joseph McLaughlin. He's a senior vice president, financial advisor, senior institutional consultant, corporate retirement director at Kelleher Corbett Group at Morgan Stanley. So thank you both so much for presenting today, and I'll now hand the presentation over to Derek to get started.
Thank you, Stephanie. Hello, everyone, and welcome to today's presentation. Thank you for taking the time out of your day to join us and being here today. We have an exciting agenda to cover, but before we get into that, I'd like to provide a brief introduction about Wolf & Company as well as myself. My name is Derek Graves, a principal in Wolf & Company's Audit Services Group. I've been with Wolf for about 20 years with a focus on employee benefit plan audits. I lead the firm's employee benefit plan audit practice and the employee benefit plan services team here at Wolf. That includes leading our annual training throughout all levels of the firm. As a firm, we audit about 80 employee benefit plans annually. Those include defined contribution plans, your 401ks, 403bs, and ESOPs. We also audit defined benefit plans, including pension plans and cash balance plans, as well as health and welfare plans. In our commitment to quality at the firm, Wolf is a member of the American Institute of Certified Public Accountants Employee Benefit Plan Audit Quality Center. A bit of a background on Wolf & Company. We are a 100-plus-year-old firm with offices in 4 locations, including Boston and Springfield, Massachusetts, Albany, New York, and an office in Livingston, New Jersey as well. As a firm, we stick to our core competencies, providing audit, tax, and risk management services to our clients. Under the audit umbrella, we have assurance services such as financial statement audits and employee benefit plan audits, where Wolf is registered with the Public Company Accounting Oversight Board, as well as the AICPA's Center for Audit Quality. Also for assurance services, we provide SOC reporting, high trust, and PCI as well, which is payment card industry compliance. Our tax services group serves corporations, not-for-profits, flow-through entities, individuals, estates and trusts as well. Our risk management group provides advisory services such as IT audit, cybersecurity, business continuity planning, internal audit, regulatory compliance, and virtual chief information security officer roles as well. Additionally, Wolf offers an enterprise risk management software solution that we call Wolfpack. This is used by our clients to automate the identification of risks, threats, and control gaps in their entity. As a firm, we have approximately 300 professionals, and we're a very niche-based focused firm. The largest being our financial services practice, which includes financial institutions and also fintech companies. As a firm, we serve approximately 350 financial institutions and fintech clients. Also tucked under the financial services umbrella is asset management, broker-dealers, and investment funds. Our other niche areas of focus include healthcare, including life sciences, manufacturing, distribution, and retail, which we have a concentration in food processors, technology companies, as well as our private client group. At this time, I'd like to hand it over to Joe for an introduction.
Thank you, Derek. Good afternoon, everyone who is joining us on the East Coast, and good morning to those of you who may be joining us from the earlier time zones today. We appreciate you taking time out of your day to join us for this session. And Jeff, if you could move on to the next slide, where I will introduce the Kelleher Corbett Group at Morgan Stanley. Our group consists of 12 professionals who have the pleasure to serve a number of institutions, not-for-profit institutions, public and private corporations, endowments, foundations, as well as individual and family investors. In my role in the practice, I am one of two practice leaders in the defined contribution and retirement plan space. We have the pleasure to serve approximately 80 plan sponsors and work with roughly 100 retirement plans for those plan sponsors. They are predominantly defined contribution plans, which include 401k, 403b for our nonprofit clients, as well as non-qualified plans, and a number of pension plans as well. And the focus of our practice is really on delivering fiduciary advisory services to all of our clients. So that includes investment advisory services, as well as investment management services. And in nearly every engagement that we have, we serve in a fiduciary capacity. Our practice has existed for nearly 30 years, and we have the privilege to serve well over 40,000 retirement plan participants at this time. Morgan Stanley, obviously a very large global institution with services available to all types of clients, from individuals to the largest institutions, and clearly tremendous amount of resources available to back our practice to help us deliver the services that we offer to all of our clients. Next slide, Jeff. One of the things that I like to begin my conversations with, particularly when we're talking about defined contribution plans, is our mission is to make sure that our clients are continuously improving their plan. And we do that by setting reliable and repeatable processes in place for them. And we start by establishing a fiduciary standard of excellence. The most common underlying theme across all of our clients is they really care about their retirement plans. They care about it as a benefit offering. They want to make sure that their benefit offering is competitive, but they also want to make sure that their employees are very well engaged with that. So we help them optimize the plan design, certainly work to improve and continue to increase over time the employee appreciation, with the ultimate goal of having all of our employee participants that we serve retire confidently. And today's topic is on benchmarking your plan. And we'll begin with how that fits into the conversations that we are having with all plan sponsors, but we're going to focus on the conversations we've been having with our credit union clients, as well as prospective credit union clients that we speak to on the next slide. And there are 5 primary areas that are being discussed today. Today's session and the conversation around benchmarking is going to focus on benchmarking plan fees. I'll introduce that in a minute and talk about Regulation 408B2, but there are a number of areas where you can benchmark your plan. And other conversations that we're having are really driven around items 2, 3, and 4, with particular emphasis on number 3. Again, particularly in the credit union space, every credit union I've ever had a conversation with, whether they're a client or they were a prospective client, very, very employee-centric organizations. Always care about the employees. If you care about the employees, they're going to deliver and provide very caring service to the credit union members. So we take employee engagement very seriously, because you can put a lot of work in as a retirement plan committee. You can design a great plan, you can have a great investment menu, you can have very competitive costs, but if the employees are not using that benefit to the fullest extent, then all of that effort is lost. And we are also very data-driven. I personally am a data geek. I like to look at data, analyze the data, see what it's telling us, try to identify trends. So for example, when we're reviewing reporting for our plan sponsor clients, we like to look at it by the role the employees play, what branch location they may be in. Is there a particular department that's using the plan better than others, or having better outcomes? So we always try to drill down into that data to see what it tells us, ultimately helping us to design better plans for our clients so that the employees are more engaged, appreciate the benefit, and get to better outcomes. Number three, as I said, has been a very, very hotly discussed topic over the past 2 to 3 years, and that is the concept of financial wellness. And these conversations with respect to including financial wellness as an employee benefit really began with our credit union clients. As I'm sure many of you on the webinar this morning are aware, you offer financial wellness to your members. And so it is incumbent upon us that serve the credit union space and those of you that work in the credit union space to carry that to your employees. And we are very pleased with the solutions that Morgan Stanley has developed in that particular space. And that may be a topic that we visit in the future for another session, since there is so much conversation around that. But certainly in our practice, we have gone above and beyond the retirement plan to make sure that we're offering comprehensive wellness solutions, education, content, et cetera, to our population of plans that we serve. And of course, retirement readiness, as I mentioned earlier, using things like plan design, using things like benchmarking. We want to make sure that our clients' plans are as competitive as they need to achieve the organization's objectives, make sure that they're one of the most competitive employers in their geography, in their industry, whatever their objectives may be. And then certainly last but not least, making sure that in a retirement plan's investment menu, both the individual choices and the structure of that menu, and we'll get very creative in menu structure using things like custom model portfolios, custom target date funds, to make sure that there are solutions available for investment options that any employee can use, from the most sophisticated investor employee to those that need the most help. And Stephanie, if you would launch the next poll question, and I'll wrap up this slide while you're doing that, because we think all of these approaches and all of these discussion points can certainly lead to meaningful conclusions if you are using benchmarking. So if you want to make sure your plan has a competitive design so that you are one of the most competitive employers in your area, you can benchmark that element of it. You can benchmark the outcomes to say, okay, we have this plan, we think it's good, but how do we really compare it to others in our geography, others in our industry? So there are a number of different ways to benchmark the plan. And today we will go with one of the most popular forms of benchmarking, which is analyzing and making a determination on your plan costs. So Stephanie, if you would wrap up that poll, please. And it looks like good to see that we do have some number of you that have undertaken a benchmarking exercise over the last 2 to 3 years, as you should. I'll comment a little further in on the presentation as to how often we think that should be happening. For those of you that haven't, certainly something that you want to consider as part of your fiduciary responsibility. So with that said, if you would jump to the next slide, Jeff, because we do believe it's an important fiduciary responsibility to benchmark the plan. And if you go to the next slide, we can look at what do the regulations actually tell us about benchmarking. And starting with, what does it mean to be a fiduciary? If you are on this webinar, very likely you serve in a fiduciary role with your retirement plan committee at your organization. Being an ERISA fiduciary over a qualified retirement plan, you're held to the highest standards known under the law. And the first one, I think, or the first two, I should say, on the slide really summarize it. You have to act solely in the best interest of the plan participants, the plan itself, and beneficiaries of the plan, with the exclusive purpose of providing benefits through that plan, and then carry out your duties. What's missing there is with the prudence of an expert in the space, right? So if you're not an expert in the space, it obliges you to make sure that you're working with experts. And you can see the last point is making sure that you pay reasonable plan expenses, which is what we're here to talk about today. So if you go to the next slide, Jeff. The good news is that there is an instruction manual for being a fiduciary. There was a link actually in the lower right-hand corner of the prior slide if you're interested in the DOL's fiduciary handbook. It was created over a decade ago at this point. I believe it was created back in 2007, 2008. And it's still relevant. And it's a very, very good introduction for new committee members. As you add folks or have turnover in your committee, it's something that we use in our practice as a foundation for education. And for anyone who would like it, feel free to ask for it in the Q&A box. And likewise, when you look at the handbook, there actually is an operator's manual, for lack of a better term, about what your responsibilities are with respect to costs and fees associated with your retirement plan. It all began, or I should say the real focus recently began with the proposal for regulation 408B2. So just like 401k, 408 is a section of the tax code, subsection B, subsection 2. It's 408B2 outlined what a plan sponsor is responsible for with respect to costs associated with their defined contribution plan, as well as service providers in the industry, what our roles and responsibilities are with respect to retirement plan fees. Again, there's a link, hyperlink in the lower right-hand corner if you would like to take a look at that, or again, through the Q&A box or through email, if you would like to ask us, we would be happy to send you that. If you move to the next slide, please, Jeff. One of the things that's most interesting is that upwards of 50 times, the words reasonable or reasonableness appear in the 408B2 regulations. And we think that it's important to understand the context around what does that mean. So from a regulatory standpoint, you are obligated to receive from your service providers, and let me define what a service provider is. That would be your record keeper, who may or may not also do the administration. You may have a third-party administrator associated with your plan. You may have an advisor or a consultant. And then you also have investment managers. Obviously, these are investment programs, so each of you has a number of investment managers providing those services to your plan. So each one of those service providers, and I will also add, since Derek is on the meeting today, auditors, if you pay for your audit costs out of the retirement plan assets, auditors are also service providers. So anyone who is being compensated for services from your plan assets, they are required to send you a 408B2 disclosure. And they need to provide the description and the array of services that they offer. They also should be highlighting the services in particular that were provided to your plan over the last 12 months. I'm going to repeat that several times as we move through some of the elements of the presentation today. They are to disclose if they serve in a fiduciary capacity for their role or not. And if they do, what type of fiduciary capacity they serve. And this tells us that the regulations clearly understand the difference between someone who serves in a fiduciary capacity and someone who does not, and also the various levels of fiduciary capacity one may serve. So they understand that the higher level fiduciary capacity is going to bring a slightly higher service cost with that versus someone who's serving at a lesser capacity or perhaps not a fiduciary at all. And then naturally the compensation, both the form and the amounts that each service provider receives. But when it comes to analyzing the costs of your plan, you also need more context. And one of the, it's kind of a silly example, so bear with me as I introduce you to my sense of humor. But if I tell everyone on the webinar today that I just bought a car and I paid $25,000 for that car, what does that tell you? Well, it tells you that I paid $25,000 for a car. It doesn't tell you what year the car is. It doesn't tell you the make. It doesn't tell you the model. Nor does it tell you what purpose or what mission I need a vehicle that I own to serve. So the fact that I paid $25,000 for a car, you could get out a database, you could go to websites that have the costs of all different kinds of cars out there, various makes and models, various years, and you can determine what the market value is for that particular vehicle. But if I just tell you what I paid, it technically tells you nothing. So if I tell you that that car that I paid $25,000 for was a 1908 Model T Ford, does that tell you anything? Well, it tells you that this is probably more of a collector's item than a vehicle that I'm going to put in service on any given day. But still, what's the value of a 1908 Model T Ford, right? You need a lot more context beyond that. And in fact, if you did some research, you'd find that in 2020, the most expensive Model T Ford sold for a cost of $24,200. So we could maybe argue off the top that I overpaid for my Model T. And that was for a model that was considered in absolutely perfect, pristine condition. But again, how useful is that car? Can I drive that back and forth to work? Can I get to my client meetings when we are out of this pandemic environment, right? So now you have more context on that, you can begin to make qualitative judgments about how I did with my purchase. Did I overpay? Did I underpay? Am I getting good value? Am I getting good use out of that? Is it providing good service to me? So again, a little bit of a silly example, but something that I like to put out there. So if you'd go to the next slide, Jeff, please. There are three primary factors, really three legal factors that a lot of these class action lawsuits have boiled down to. And there have been a number of these lawsuits that have occurred over the past decade or so. Some of them for very large Fortune 100, 500, Fortune 1000 size companies, but they've also been trickling down to plans that have, $50 million, $100 million, $200 million in plan assets. So a lot of accusations out there. Some of them have been very well defended. Others, there have been some plan sponsors that have had to create settlements and have had judgments against them. But there are three major legal points that have come to summarize each of these cases. The first is that the costs associated with any retirement plan need to be reasonable, not necessarily low. There is nothing out there in the regulations that say thou shalt have the lowest cost investment options, the lowest cost service providers, et cetera. They have to be reasonable. They understand that certain organizations want to have a plan with a high level of service. Others may not need to offer that same level of service. Maybe they have the internal resources to provide those services themselves. So they understand that there's a marketplace and an array of services that plans may need. The second is that fees cannot be considered in a vacuum, right? I can't tell you that I paid $25,000 for a car and have you make any judgment as to whether that was a sound decision or a very bad decision. And the third item, this is very important, we'll talk about this more as we move further into the presentation, is the determination needs to be made at the service provider level. And I have a great example for that with a client that we work for that I'll lay out for you as we move through the presentation. Next slide, please, before I get into some of the specifics on fees. And really, this is the second reason why, or second item, why costs and fees matter, but how other variables can matter more. So if you go to the next slide, we do have a poll. And while the poll is coming up, before you click your answer, please let me explain. Let's assume that at your credit union, starting today, you have a female that's 42 years old. You're starting her out today at a $40,000 salary. She has, or she will receive 3% raises over the course of time. You automatically enroll her immediately at 6% in your plan because you have an employer match that matches 50% of the dollar up to 6%. So you want her to get that full matching contribution right away. She invests for the next 25 years, the duration of her career, and earns a rate of return of 7.11%. The costs associated with your plan all in are 72 basis points. And this woman who you just started today is going to retire at age 67. So you see 6 variables listed there on the poll. If we change any of these variables by 20%, which is going to have the largest impact on this person's ability to retire comfortably? And if you look to the right side of the slide, we have some factors there. So again, before you finalize your answer, if we project out to her age 67 retirement, using that 3% increase annually, her final monthly pay at age 67 is going to be just under $6,800. In order for her to retire comfortably, she's going to need to replace 82% of that, or $5,500. She's going to get about $3,500 from Social Security, almost $1,400 from her retirement plan balance that she uses to purchase an annuity to last her the rest of her life. So her total retirement income is going to be $4,860. So she's going to replace 72% of the 82% goal that she has. 72% of her 100%, which gives her an 87% readiness score. So as your record keepers measure this, she is 87% of the way towards her goal of replacing 82% of her income. So which of these variables is going to have the greatest impact? And go ahead and close the poll, Stephanie. And Jeff, we'll move on to the next slide and the results. And it looks like most of you did determine correctly that if she retires 5 years earlier, she's going to have the biggest, in this case, negative impact on her retirement savings. So that should come as no surprise, and obviously did not come as any surprise. Starting earlier, obviously that has a meaningful impact, particularly someone starting in their 30s instead of the 40s. Increasing her rate of return obviously has some impact there. Would increase it by 6 points, the next largest factor. But I would submit to you, in our practice of doing this for almost 30 years now, that's not something she can necessarily control. She can't control the markets. She also can't control the fact that she really needs to become a more conservative investor as she gets closer to retirement. So very difficult to rely on a better rate of return as a mechanism for closing the funding gap. Interestingly enough, the one variable that she can control the most is increasing her deferral from 6% to 7.2. And in doing so, you see improves her retirement readiness score by 4%. And I'm going to just jump right to the end, decreasing the fees and the costs associated with the plan by 20% only has a 1% impact on her retirement readiness score. Now, again, I'm not implying that we should ignore them because it would be great to improve her score by 1%. But in fact, the biggest variable that she can control, increasing her deferral rate, is going to have a 4 times impact on that. On the next slide, Jeff. So why would we focus on that particular element? In the context of plan costs, if you have service providers, be they record keepers, advisors, whoever you're using to try to improve outcomes for your plan, if you have providers who deliver very solid education, that lead to the results and the changes in behavior that you would like to see, they can have the most material impact on helping your employees achieve their retirement readiness. So in this case, our young lady that we hired at age 42 works for the credit union for 25 years. You can see we're able to add $38,000 of account balance as the absolute difference and improve her retirement readiness score by 4%. Again, if you're working with service providers that are able to deliver those types of results, that gives you the context to be able to quantify and also make qualitative decisions as to the reasonableness of the costs associated with your plan. Next slide, please, Jeff. Okay, so let's get into the essentials of benchmarking. So we've set some framework about why benchmark is important, where costs factor in to the overall evaluation process. So let's get into the 7 specific items and then defining what we're trying to accomplish here. Right, we are trying to make a judgment, and really what the DOL ultimately wants out of you as a plan sponsor and as a fiduciary is to make a judgment or a determination that the costs associated with your retirement program are reasonable in light of the services that are being provided, right? So you are making both a quantitative and, at the end of the process, a qualitative judgment. So you want to make sure that you can form an educated, informed decision, that you've weighed all the elements and evidence that's available, and that you have some context, back to my automobile example, to make that judgment. So again, one of the, you can move to the next slide, please. As we're going through this process, you're going to hear me reference an organization called FBI. It's not the government agency. It's an organization called Fiduciary Benchmarks, Inc. They're an independent third-party benchmarking organization. They collect about 300 to 350,000 plans worth of data each year. And there are approximately 700,000 defined contribution plans out there. So each year, they're collecting nearly half or sometimes half of the entire retirement plan universe out there in the United States. And they're collecting that data directly from the sources. They're collecting it from record keepers. They're collecting it from third-party administrators. They're collecting it from investment managers, and they're collecting it from advisors and advisor teams such as ours. So when we are going through and benchmarking our client plans, we are using Fiduciary Benchmarks, Inc., or FBI, and we literally have to go through and complete a very detailed questionnaire for each and every client that we benchmark. We have to list all the advisory services, not that we provide in total, but those that we provided to that plan over the last 12 months. We have to quantify that with the number of hours and the number of times that we provided each service, and naturally overlay that with the cost that we have for the services that we provide. And this helps FBI to create their universe. So record keepers are doing the same thing. Investment managers, obviously a little bit more simple, because if, particularly if you're using registered mutual funds, they have expense ratios, and those are all quantified in there. But the bottom line is that it's based on the services that are actually provided to that plan over the prior 12 months. Next slide. Because the reason it's important to quantify at that level of detail is you want to build a very detailed, reliable, and repeatable process, because there is a vast array of services available out there in the marketplace, from record keepers, from third-party administrators, from advisory service firms, from audit firms, et cetera. So again, anyone who's being compensated out of your plan, you need to be able to quantify all those services, identify the fact that you've received them, how those services are being delivered, and the frequency of them. And the best example I can illustrate there, and I will go back to my client example that I mentioned, I just had a meeting on Monday with our largest credit union client. They've been with us since 1998. They have, over that time, been one of the fastest growing credit unions in the country. They now, at the end of 2020, are among the largest credit unions in the country. And one of the things that we do for them, part of our engagement with them all the way back to 1998, is they are a very, very employee-centric organization. They care very deeply about the success of their 401k plan, and they hire us to be involved with their onboarding and enrollment process. And they actually, we deliver one-on-one education. We're doing it virtually now, but normally in person, to every one of their new hires, right? So if you think of a credit union that's been, for the last 22 years, one of the fastest growing credit unions in America, and now is among the largest credit unions in America. They have a lot of employees, and they've obviously had some turnover. So we are intimately involved. We literally are meeting with every employee that comes through the door as part of their 401k enrollment process. Now, it doesn't take much imagination to figure out that that's a very labor-intensive service that we provide. And that obviously comes with a cost. And I can tell you that when we benchmark the advisor costs for this particular client, we are off the reservation as far as the averages, right? But we're providing service that goes above and beyond what other advisors are doing for comparable clients of comparable size, right? So that's something that needs to be in there, and providing education in person is more expensive than providing it over the web. Providing live sessions over the web is more expensive to deliver than providing pre-recorded sessions that people can watch on their own. So even just with the topic of education or the service of education, there is a vast array of the type of services that could be offered, the frequency of delivering those services, and the methods of delivering those services. So all of those things need to be factored into your evaluation and your benchmarking process. And so moving on to number three, essential number three, making sure that you have a benchmark group that is appropriate for your plan. And starting with the first point, it does need to be economically driven. Plan assets determine the sphere that your plan fits in. The number of participants or employees that you have within your organization that are part of your plan matters to a great deal. They technically represent unit costs in providing services to your plan, as well as average account balance. Let me give an example. If we're going to benchmark two $50 million plans, so each plan has $50 million in assets, if you're benchmarking a plan with 800 participants and $50 million in assets, and then you have another plan that is 50 million in assets, but they have 2,000 participants, they are not in the same benchmark group. Those two plans should not be compared to each other just based on that fact alone, because the number of investors, the number of participants that need to be served in the 2,000 headcount plan versus the 800 count plan, they're just two different spheres. So economically driven needs to be taken into effect, as well as when you look at the universe for a benchmark comparison, you want to make sure that you have outliers removed so that the data is clean and that you have a good set. When you're looking at plans and benchmarking the advisors, you want to make sure that you have a number of different advisory firms represented, as well as different advisors, even if they may work for the same firm, because there are different levels of service being provided to different plans, et cetera. And then when it comes to record keeping, this is where you tend to see the smallest number in your peer group, because this is where the service costs can vary the most, is with the record keepers, again, by headcount, by whether there's education included or not. So you want to make sure that you have good representation there, but not too big, and also make sure that you have different types of service models represented, be they record keepers that are owned by banks, by mutual fund companies, independent record keepers, whatever the case may be. Next slide, please. And clearly the quality of the service that you receive matters. So this is where you switch from quantitative data to qualitative analysis and judgment. So back to my example, that credit union that I met with earlier this week, when we benchmarked their plan on an all-in cost basis, so you add in everything, the cost for the investments, the record keeper, they do have a TPA, and the advisory services that we provide, all in for their peer group, they are actually in the lowest cost quartile. Right, so their plan on the surface looks to be very inexpensive. Yet I told you as a component, so at the service provider level, when you look at our costs, again, looking at them in isolation, we are an anomaly. We're off the charts in terms of where our costs to serve their plan lie. But then when you dig deeper, they obviously are receiving a tremendous volume of service from us in terms of manpower, hours, locations that we have to serve, all of that sort of stuff. So quality definitely matters, and the DOL has been very explicit about that. If you would move to the next item, please. Number four, consider the quality of the service, and I love the word fit in the first bullet point there, because whether it's the record keeper, whether it's the TPA, whether it's the advisors or consultants that you work with, it's very important to have a good cultural fit. There is no one record keeper out there that can serve all plans. There is no one record keeper out there that can serve all credit union plans. Even though we have a lot of experience working with credit unions, doesn't mean that we are the best advisor for every credit union out there. Your culture at your organization needs to have a good fit with our culture, how we deliver our services. When you have that fit, there is economic value to having that fit, is my point. And you really should be looking at that across all of your service providers. In terms of what the services are offered and the procedures and processes and protocols in place, do you have a mutual definition of how your plan defines success? Are you getting there? What are the things that are being done to protect you as the plan sponsor from liability, making sure that we're improving the outcome, and then obviously the resources that your service provider have definitely can help you add qualitative judgment. Next slide, please. And this is where number 5, understanding the scope of services. And one of the things we like about FBI is, as you see in that illustration towards the right side of the slide, they identify, in this case, the services that record keepers provide. And then you see the check marks for the services that this particular plan received in the last 12 months. And you see that on this particular plan, they have more boxes checked in the small cost impact services, some checked in the medium, and none checked in the large, right? So the fact that they're paying more for their record keeping than others in their peer group, yet they don't have any box checked in the large cost impact, it tells them that they need to examine a little bit further. It doesn't mean it's necessarily bad. There could be other qualitative factors that their record keeper is a great fit. They do this extra stuff that we haven't yet quantified. So again, having good context around that and understanding the scope of services you receive. Next slide, please. On number 6, again, I've said it before, quality matters. Are you getting what you need accurately? Are you getting it timely? Are you getting extra levels of support? Are you getting assistance with your plan design versus you being left out to make your own decision? So you have the opportunity to examine the value that your service providers are making. And then one of the final points, or the final point on the next slide, number 7, is obviously tracking costs down and getting granular, but also being able to quantify and validate extra credit, right? I give you a great example of all the extra work that we do for this particular client. That is not something that we do for all of our clients. They are very, very unique in that regard. We have some clients where we provide no education service. That's not what they want. They do things internally, or the record keeper is doing it. They've decided it's not a service that they need from us. So their pricing structure looks very different. But when you get into, this is what FBI calls their fee point, where they can take the elements of your plan, the service component, the array of services that you're receiving, and they can quantify it and break it down into hours and units and things of that nature by having the service providers enter that information and the hours associated with it. Here is where you can begin to validate, hopefully validate and take comfort and find value in what your service providers are doing. So obviously you want to make sure that you know what your fees are, compare them to your benchmark group, but be able to quantify and validate, especially if your plan is a higher cost plan, be able to validate some of those extras that your plan may be receiving. So those, next slide, we'll just again re-summarize the 7 essentials to benchmarking, which, going back to the beginning, is making sure that you have the right data. Ideally, you're getting that data or having that data entered directly by each service provider. Have a repeatable and reliable process that's fair to all parties involved. Make sure that you have custom benchmark groups for each service provider. So one benchmark group for your investment managers, one for your record keeper, your TPA if you have one, your advisors, and make sure that each is benchmarked accordingly. Obviously, take into account the quality of the service that each of those providers offer. Look at the scope and the array of services and determine which services are more expensive, right? So you may be getting a lot of expensive services like the education I mentioned that you can validate what you're paying. And then the last step, make sure that you're examining the value that's delivered to you as the plan sponsor. Are they making you and your administrative team, are they making their lives easier? And are they making your employees' lives better by better preparing them for retirement? And then lastly, again, track and compare fees, but make sure you're fair with your service providers and that you can account for any extra work that they're doing. So one more slide, if you would please, and I will wrap up here. Again, we think when it comes to benchmarking your plan, doing it in a very thorough way and doing it using a resource such as FBI obviously benefits your employees, your participants, because they are paying reasonable fees. And again, hopefully getting to very successful retirement outcomes, and you were able to quantify and measure both of those things. For you as the plan sponsor, you have a prudent, repeatable, reliable process that can help you validate what you're doing, ultimately protect you from liability. And for the service providers, it allows you to engage directly with them and make sure that you are ultimately receiving good value in whatever array of services you may be paying for, whether that is a minimal level of service or the maximum level of service available from each of them. And that is the conclusion of my presentation. I do see there are some questions that came in during the presentation that we will answer in the end. So I thank you all very much for your time. And Derek, I will turn the presentation back over to you for your topic today. So thank you very much.
All right, thanks, Joe. Excellent perspective and points in regards to the fee reasonableness and documentation considerations. You know, as auditors, we look kind of beyond those financial numbers that are in the statements and take a very qualitative audit risk approach. And I think what Joe spoke to specifically regarding to those, you know, those fees and assessing them for reasonableness, you know, we look as auditors to those plan committee minutes as evidence of compliance to this. We want to make sure that you're documenting the fact that you're assessing the fees for reasonableness, and we encourage our clients to document these as best practices. And I know that with many of the plans that we work with, their advisors assist them just like Joe and his team assist their clients in complying with these fee type of disclosures. So today, the topic that I'll be discussing, we'll be covering a recent auditing standard that was formed and discussing a little bit of the impact on you as a plan sponsor as to what the standard is going to be requiring you to do. This standard is auditing standard number 136, Statement on Auditing Standards 136, which is forming an opinion and reporting on financial statements of employee benefit plans that are subject to ERISA. And this was issued by the AICPA's Auditing Standards Board. So my agenda today will include a little bit of a background on the standard, talk about why it was issued, the impact on you as a plan sponsor, and then ultimately when will this be effective. So let's start off with the background. And Stephanie, you can kind of launch that polling question as I get into a little bit on the background, but the AICPA's Auditing Standards Board worked on a broad project regarding auditor reporting that's going to affect all entities. And out of that, a standard was issued that applies specifically to employee benefit plans. So in general, a plan that is required to have an audit, it has 100 or more participants. And this standard is going to apply to any of those plans that have audits. So the standard does address auditors' responsibilities in forming an opinion on the financial statements of an employee benefit plan that is subject to ERISA. It also addresses the form and content of the auditor's report. Thanks, Stephanie, for launching that. It does look like some of you do have an audit requirement. So let's talk about why this standard was issued. Over the past several years, I think, Jeff, you can slide it forward just one. Over the past several years, the Department of Labor has voiced some concerns over audit quality. And I think this goes to Joe's point as well in regards to quality when you're picking an advisor as well, talking about the fees. So an audit quality study was released back in 2015 by the Department of Labor, specifically by the Employee Benefits Security Administration, which is a division of the Department of Labor. They completed an assessment on the quality of audit work with respect to the financial statement audits of employee benefit plans covered under ERISA. The primary objective of their review was to assess the level and quality of audits covered by the employee benefit plans. The assessment involved a review of the Form 5500 annual filings and any audited financial statements that were attached thereto. So what the agency ended up doing was they looked at 81,000 filed Form 5500s and selected a sample of about 400 plan audits. And what they did is they pulled those audit work papers for adherence to the auditing standards. One fact within the study is they discovered that there were 7,000 different CPA firms who performed those audits. And as a result of this study, the DOL estimated about 40% of the ERISA audits had major deficiencies. So the Department of Labor was not very happy with this audit quality. And I think, it speaks to Joe's point about quality in regards to his presentation. There were a few findings within the study that are interesting that I'll point out. One of them being a clear link between the number of employee benefit plan audits performed by a CPA and the quality of their work performed. The CPA who performs the fewest number of employee benefit plans on an annual basis had a deficiency rate of about 76%. In contrast, firms performing the most plan audits had a deficiency rate of only about 10%. So again, that goes to Joe's earlier point regarding fee reasonableness and the quality of the service provider. It really does matter. The study also found that CPA firms that were a member of the AICPA's Employee Benefit Plan Audit Quality Center tended to produce audits that have fewer deficiencies. Another finding in the study said training specifically that was targeted to employee benefit plan audits contributes to better audit work. Also, the study found that audit areas that are unique to employee benefit plans, such as contributions and benefit payments, participant data, party and interest transactions, and prohibited transactions, continue to lead the list of the deficiencies. And I bring up that point because the new standard specifically addresses these areas. As a result, the standard was issued to address some of the audit deficiencies exposed during the Department of Labor audit quality study and explicitly document what the plan provisions should be considered by auditors. So the standard explicitly documents areas such as contributions, benefit payments, and participant data should be addressed during the auditor's risk assessment and the testing performed. The plan provisions listed in the standard will not likely impact your current auditor's approach, since many firms that adhere to quality are already performing these audit procedures related to plan provisions. And I also like to point out that this standard was drafted in collaboration with the AICPA's Auditing Standards Board, the Department of Labor, audit firms that perform those annual audits, as well as folks that are in the industry. Now, in the next slide, we'll discuss a little bit more about the standard and the impact on you as a plan sponsor. Some of the objectives of the standard are as follows. It wants to provide the reader of the financial statements with a better understanding of the scope of the audit, especially in a limited scope audit, which we'll get into in a little bit. It also makes clear the responsibilities of the plan sponsor, you as the credit union, and also us as the auditor. The impact on you as a plan sponsor is that your responsibilities of management are described in the auditor's report or the opinion, and it's going to specifically state that management is responsible for the preparation and fair presentation of financial statements in accordance with generally accepted accounting principles, as well as management being responsible for the design, implementation, and maintenance of internal controls relevant to the preparation and fair presentation of financial statements that are free from material misstatement. Now, those two statements are already in the current auditor's report, but will continue to be disclosed in that audit opinion. A few other things that will be disclosed is the fact that management is required to evaluate whether there are any conditions or events that raise substantial doubt about the entity's ability to continue as a going concern. This really just speaks to as if there's any issues with the plan continuing in the future, the overall plan sponsor health as well as the plan itself. Will they be able to continue to fund the plan? Also, that is going to be explicitly documented within the auditor's report under the management responsibility section is that you are going to be responsible for maintaining a current plan instrument, including any amendments. You're responsible for administering the plan, and you're also responsible for determining the plan's transactions that are presented and disclosed in the financial statements are in conformity with the plan's provisions, including maintaining sufficient records with respect to each of the participants to determine that the benefits due, or which may become due in the future to such participants. I think a lot of this, you're outsourcing that already to some of your service providers to assist you in doing these things. Like I mentioned, the most significant change in the impact on the auditor's report is really the language in the existing report is going to be reordered, clarified, and expanded to clearly express the audit opinion. It's going to look significantly different. The opinion is going to be listed at the beginning of the report as opposed to the end, which is a big change. Let's talk a little bit now about limited scope audits. And Steph, can you launch that final polling question? Historically, plan administrators can instruct their auditors to perform what is referred to as a limited scope audit. In those instances, the auditor is not going to perform any auditing procedures at all with respect to assets held for investment and related investment income. That limited scope audit is acceptable if that investment information is prepared and certified by a bank or a similar institution or an insurance carrier that is regulated, supervised, and subject to periodic examination by a state or federal agency that acts as a trustee or custodian. All right, great. Thanks, Stephanie, on that. It looks like that most have a limited scope audit, which is common. I would say about 85, 90% of the plans that we work with in regards to that space have limited scope audits. A limited scope audit is permitted under the ERISA section 103A3C, which is just the section of the law that allows it. And the auditor's report is now going to make reference to the fact that management, having determined that it is permissible to have a limited scope audit, has elected to have those audits performed in accordance with that section of ERISA. Also, it's going to specifically state that management has obtained certifications from those qualified institutions, stating that the certified information is complete and accurate. Another point from this standard is that historically, if an auditor was engaged to perform a limited scope audit, a disclaimer of opinion was rendered since the auditor did not perform any work on that investment information. This standard still allows limited scope audits. However, as auditors, we are no longer going to be allowed to disclaim an audit opinion simply because we're performing a limited scope audit. The audit opinion will include information on procedures performed on both the certified and non-certified information. So as plan sponsors elect to have auditors perform these ERISA Section 103A3C audits or limited scope audits, they're going to have to assess whether the trustee or custodian issuing the certification is a qualified institution. They're going to also be responsible for ensuring that certification meets all of the ERISA requirements. And also, management is going to have to gain an understanding as to which investments and disclosures are certified. And then finally, management is going to have to acknowledge this in writing whether all conditions are met. This will likely be done through the execution of the audit engagement letter and the management representation letter. Another component that's going to impact plan sponsors is reportable findings, which is defined as any non-compliance with laws and regulations of ERISA, an audit finding that is relevant to those charged with governance, or it could be perhaps an internal control deficiency. One of the ones that we see most of the time are late remittances of participant contributions. Those would be considered a reportable finding. And as auditors, we're going to be required to communicate any of those reportable findings in writing to those charged with governance. I'd like to just reiterate a couple of the plan sponsor responsibilities is that you as a plan sponsor are going to be responsible for maintaining a current plan document and any amendments, which include any updates for any changes in law. So think of the CARES Act and the Secure Act and those types of things. You're going to have to continually to maintain and update your plan document in accordance with these law changes. Also, the plan sponsor must maintain sufficient participant records in order to determine the benefits that are going to be due currently or in the future. Now, when is this standard going to be effective? It was originally effective for periods ending after December 15, 2020. So for calendar year end plans ending in 2020. However, because of the COVID impact, the AICPA has deferred this for 1 year. So you're going to see this standard become effective for plan years ending with a calendar year at the end of 2021. So it'll be not through this year's cycle of audits, but the next year's cycle. All right, Stephanie, do we have any questions?
Hi, everyone. So we did get a number of questions come in. Just as a reminder, if you have not submitted any questions yet and do have them, please use the Q&A box at the bottom of your Zoom control panel to send those along. So I'm going to go ahead and get started. And the first question that we received is, how frequently should we benchmark our credit union employee benefit plan?
Stephanie, I'll assume that question was directed toward me since it's benchmarking. And it's a multi-part answer. I would say if you have a smaller plan, and by small, I would say probably less than $25 million in assets, you're going to want to benchmark that plan probably to no more than 3 years apart. But there's also some qualitative judgment there as well. If your plan is growing fast, I think you want to benchmark it more frequently than a plan that's has a relatively stable employee population. If it's say between 25 and 100 million, pretty consistently you're going to want to benchmark that plan about every other year. And if your plan is larger than 100 million, you're probably going to want to benchmark that plan on an annual basis. And then I would also add that there are different forms and different methods to benchmarking as well. So you don't have to apply the same methodology every single year. If you have a large plan, you may undertake different forms of benchmarking, such as using FBI, Fiduciary Benchmarks Inc. You're going to want to periodically put your plan out to bid, whether you have any changes in mind or not. Sometimes you want to do that just to renegotiate with your current service providers. So we'd be happy to talk more about that with anyone who is interested in diving deeper on that topic.
Great, thank you, Joe. It looks like our next question is for you, Derek. How do I know if my plan is required to have an audit?
All right, well, thanks, Steph. Plans that have 100 or more participants are generally considered large plans, and therefore an audit requirement is required. However, there's always exceptions to every single rule that's out there, which is called the 80-120 rule. So if your plan started off and you had less than 100, considered a small plan, not requiring an audit, you don't really necessarily need to have an audit until that participant count gets to 121 or more. So therefore, thereafter, you would consider it to be a large plan and have an audit requirement.
Wonderful. Thank you, Derek. And our last question we received is, how are the findings and outcomes of current litigation impacting how a fiduciary should think about benchmarking?
Yeah, that's an excellent question because there has been a lot of litigation out there. I would say the result so far of that is that clearly you want to make sure that you have a prudent, reliable, repeatable benchmarking process in place. You can use the guidelines that I gave with the prior answer for the timing and frequency and so forth. But I think it's important to make sure that you are looking at your plan costs in total, certainly looking at it by service provider components, your investment managers, your record keepers, your administrators, your advisors, and that you're going to the depths that I mentioned in the process to, particularly if you're among the higher cost plans or you have a wide array of services that are being offered to your plan. So the more complex your plan is, the more services that are being offered to your plan, the more effort you want to make to document those services and to collect data and information that helps you validate those services. And then again, overlay them with your outcomes. If you have 100% participation, you have average deferral rates of 9–10%, you have a lot of 100% retirement readiness scores in your plan. Those are all elements that you can use to validate paying your service providers a little more if they're giving you the results that you would like to see for your plan. So again, and as Derek alluded to, documenting those findings in the committee meeting minutes. So they are out there and available for folks to see that you've gone through that work and that you've tracked those results.
Great, thank you, Joe. And it looks like we are just hitting our timeline as we approach the end here. So I just want to point out that if nobody has any further questions, please feel free to contact Derek or Joe directly. Their information is included in this PowerPoint, and they will ensure that you receive a response as soon as possible. And just a reminder, a copy of today's presentation and the recording will be sent out 24 hours after the conclusion of this webinar. And we just want to remind you that part 2 of our webinar series will take place on Wednesday, February 24th. We will be talking about best practices to mitigate and respond to ransomware. And we will also be featuring Will Nowick, one of our cybersecurity experts at Wolf & Company, along with Joe McLaughlin, who presented today. So you can utilize the QR code on this screen to hover over it, and a link will pop up, and you can fill out the registration form and submit your registration there. And just a reminder, immediately following the conclusion of this webinar, you will have the opportunity to complete a survey. As always, we appreciate your feedback so that we can continue to improve our webinar program. And we hope to see you at a future webinar. Have a great afternoon, everyone. Thanks so much for attending. Thank you, Joe, and thank you, Derek.